The opinions expressed on this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial advisor, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC. This is the Margie Shard Show on Super Talk 1570.
I'm Margie Shard, and you're listening to the all-new Margie Shard Show on Super Talk 1570. So I'm so excited to kick off my new radio show about finance, business, community, and the things that affect our lives on a daily basis. And the show airs each Sunday on Super Talk 1570 from 10 to 11 a.m. and is also available via podcast each Tuesday through our website at shardfinancial.com. To ask questions or talk to a financial advisor, go to www.shardfinancial.com and click on the Ask Margie a Question link. So today in the studio, we have my Director of Operations from Shard Financial, Jen Verschuer, back in the studio. Jen, welcome back.
Thanks, Margie.
And we're going to talk today about our annual forecast. So what are we projecting for 2015 on the economy? But before we do that, and Jen doesn't know what I'm about to pull out here, last time Jen was in the studio, we talked about New Year's resolutions. And one of the things that Jen wants to do is get fit this year, which really surprised me because Jen's never sweated before. So Jen's comment was, what was your comment about exercise, Jen?
What did
about your relationship with exercise?
I really don't have one.
Yeah, you said you had a bad relationship with exercise. So just because I really want Jen to hit her goal, we're going on a trip tomorrow. Jen and I have a trip for work down to Orlando to learn about some new investments, and we are going to work out when we're down there, Jen. So bring your sneakers and some workout clothes. Do you own workout clothes?
I do.
Pack them up, baby.
I do. Okay, I'm going to have to repack.
Okay, so, all right. Well, now that we've talked about that, we'll have to fill you in on how that works. Maybe I'll take some videos or pictures, post it. Jen's cringing right now. Okay,
Big time.
So Jen, let's talk about 2015 and what we think is going to happen with the economy and the markets. And, you know, one of the things that I know you and I have talked about a lot is when we look ahead into 2015, we really see a year that's going to be marked by transitions.
Right. The U.S. economy is continuing to transition from a slow growth to a more sustained market.
Well, and when we talk about that, we need to talk about the labor market. You know, we probably should talk a little bit about inflation. So let's start with the labor market. I know that, 2014, we saw a lot of really big numbers being posted. We had consecutive months, month after month, of 200,000 plus jobs being added to the economy. And we also, one of the reasons I think we're seeing that is because of all the onshoring.
Right. We have companies that are now moving their operations from overseas back to the U.S.
And when we talk about onshoring, a lot of people wanted to know, we've talked about this actually for the last, probably the last few forecasts that we've done. But one of the big reasons that we've actually been able to onshore and companies have left countries like China and Thailand and Mexico and it is really because our wages in this country really went down and hit bottom. And those countries' wages have gone up. And so there's been a big incentive for companies to actually come back here because of our wage, the wages that had bottomed out, basically.
Right, and we're also, we have growing population. We have more workers, while the other countries are actually showing a decrease in workers.
Which makes sense why companies wouldn't want to make a big investment in those countries. If they're not going to have the labor force down the road, it just makes sense that they would bring that here. And of course, we've had a lot of cheaper expenses because of all the natural gas and things like that as well. So the onshoring has really been strong. And I know we talked about how our wages went down, but last year, for the first time, we actually started seeing, an uptick in wages. We saw clients actually coming to us and saying they were getting some pretty substantial raises for the first time.
Right, that's right, Margie.
And some of these clients of ours, I mean, it had been 3, 4, 5 years that they had been working with no wages, no bonuses, no overtime. So we're still lower than the rest of the countries, we're still at a good point from our bottoming out, but we're at least starting to see as the economy's going up that that employees are starting to get paid better. So let's, from the labor market, we really need to start also talking about inflation. We've had this concept of no inflation for several years. I mean, rates have been bottomed out for 5-6 years now, and we're back at record lows. When we looked at the summer of 2013, we actually saw rates move up a little bit, which then, of course, made bond prices fall. And we thought going into 2014 that we were going to continue to see rates increase. Now, we know that last winter, everybody remembers the cruel winter we had last year where the economy was just frozen and we lost about 3% GDP the first quarter, which really resulted in a really bad, just a lot of over $1 trillion lost of money in our economy. So what happened is the Fed came in and said, you know what, we're going to continue to start the tapering process where we're no longer giving as much money to the banks because, again, the quantitative easing or stimulus money, they were giving $85 billion, billion with a B, $1 billion a month of cash to the banks, and in return the banks were giving our government mortgage-backed securities. But they started reducing that. And so the Fed said, you know what, while we're tapering down this quantitative easing and reducing this money, we're going to reduce rates again. And so we actually saw a decrease in rates last year, which really surprised us.
You're right. It was a surprise.
And so when we look at, where we're at now, October, they ended the quantitative easing, and we're no longer giving the money to the banks, and we're also still seeing a strong economy. So we're really expecting rates to start to tick up here.
And so when rates go up, what's going to happen is your bond prices are going to fall. And this is an area that we've been talking to our clients about, that they really need to be cautious because, they're going to be holding declining assets.
And I think that's something that a lot of people really have underestimated. I mean, bonds are typically safe money, and we're going to talk a little bit more about this in our show later, but to have your money where you think it's a safe asset, and then all of a sudden what's going to happen is people are going to be opening their statements and saying, oh my gosh, I'm losing money, what's going on? And so we'll talk more about this later in the show. One of the other things we really should talk about is the Eurozone and Japan, which is the world's second and fourth largest economies respectively, really could benefit because the central banks in those regions might embark on a more aggressive policy action. And that would aim at restarting and reaccelerating their dormant economies. I mean, we'll talk more about the Eurozone a little bit later as well, but we know that they're now in a third recession, which obviously isn't good. So we'll talk a little bit more about that.
Margie, we should also talk about the recent shift in political balance of Congress.
I know the Republicans have taken over the Senate. I mean, who saw that coming?
Not me.
I didn't see that coming. So, I think the thing with the Senate being taken over by the Republicans is as we approach the debt ceiling limit, we might have some opportunity for maybe some movement out of the gridlock that's plagued Washington. And we've really not seen, it really has been gridlock. I mean, fiscal cliff, debt ceiling, we went through all that a few years ago, and things just haven't changed. It's so we might see some of that changing. But Jen, I know we've been discussing this a lot, and we've really been talking about 2015 returning to normal volatility.
Yes, we've not had normal volatility. Stock prices, may record their 7th consecutive year of positive returns, but we've only had 3 pullbacks that have been greater than 7% over the last couple calendar years. So 2015 will probably be a bumpy year with lots of volatility ahead of us.
Well, and I think when our listeners and our clients, what they need to know is that since we had some volatility around 2009, a lot of volatility actually when the Dow hit 6,000 again. And, we had a couple years of volatility, but the last few years have pretty much been a smooth ride sailing up. And so when we look at the fact that, we're going into a more normal, volatile trading pattern, you really are going to have to put emotion aside, and you're going to have to look at your long-term goals, and you're going to have to really have a financial manager on your side that really knows what's going on in the market and the economy, and can guide you as far as whether this volatility is normal or if it's something to be concerned about.
That's right. Like you said, clients really need to keep those emotions in check and, rely on their financial planners.
And so one of the things we'll be talking about when we come back into a couple of our, after our break, is we're going to talk about, as advisors and planners, what are we looking at when we're managing your money and we're telling you, hey, hold tight, it's just short-term volatility. How do we know that it's short-term volatility, or why do we think it's short-term volatility? Because obviously the crystal ball is never 100% accurate, but what are the things that we're looking at to really determine, to be able to say to you confidently, yes, we believe this is short-term volatility, and buy more or get out now? So I think that's a really important thing, and I think that clients, they obviously they want to know that somebody's watching their money and that they're on top of this, but it's really good for clients to have an understanding of what it is that we're looking at and why it is that we're saying what we're saying. And just to back up real quick, when we talk about rates going up, we should see a little bit of increase in inflation as well. Inflation's been holding around 2% or less, and it really does need to start moving up. So we'll talk a little bit more about that later as well. Coming up in our next segment, we're going to discuss our projection of how these transitions are going to impact our economy. So stay tuned. Before we go, I want to thank our sponsors, Rebecca Bartley with Icon Mortgage Lending, Christy Candleberry with the Christy Candleberry team at Remax Grand, and Jason Orton with the David Chapman Agency. You're listening to the Margie Shard Show on Super Talk 1570. Stay tuned.
Margie Shard and her team can help you through life's transitions, whether it's retirement, widowhood, divorce, or remarriage. Call 810-714-5566 for a free consultation. With Shard Financial, you'll get answers and results. Her office is at 1537 North Leroy Street in Fenton. Log on to her website at shardfinancial.com or call 810-714-5566 today. Securities and advisory services offered through LPL Financial, a registered investment advisor member, FINRA, SIPC. Shard Financial presents Backpack Night, March 5th at 6 p.m. at the Holiday Inn Gateway Center, sponsored by Chassé Ballroom and Latin Dance Studio of Fenton. Backpack Night is a fundraiser for a project of the Food Bank of Eastern Michigan, providing over 15,000 hungry children in Genesee County with a backpack that contains breakfast, lunch, and dinner each weekend and throughout the summer. You can help. Join us for Backpack Night, where you'll enjoy a strolling dinner, a fashion show, a comedy show, live and silent auctions, and more. Call 810-577-5291 or go to backpacknight.com for more information.
Looking for a mortgage loan and need someone that you can trust with the biggest financial decision that your family will make? Hi, I'm Rebecca Bartley from Icon Mortgage, and I have 17 years of experience in this business. I offer on-the-spot pre-approvals so that you can start the search for your new home. From zero-down rural development loans to conventional and veterans loans, I can make it quick, simple, and all understandable. Put your trust in me, Rebecca Bartley, and call me today to take that first step toward home ownership. You can reach me at 810-516-4227 or go to my website at rebeccabartley.com.
Are you getting ready to sell or buy your home? Need some real honest advice? A realtor who will actually get real with you? No false promises, just plain good old-fashioned care, trust, and advice? Then you need to get Christy.
Hi, I'm Christy Candleberry of Remax Grand. I have 20 years experience in this area, and the number one value I bring to my clients is trust and honesty. I get real with them, and I get them moving in the right direction. Call
810-691-5914. That's 691-5914. Or go to getchristy.com.
You're listening to the Margie Shard Show on Super Talk 1570. Welcome back, listeners. We are talking about our 2015 annual forecast today, and I'm in the studio with my Director of Operations from Shard Financial, Jen Verschure. And we are going to talk next about our growing economy and a little bit about the stock and bond market. Jen, one of the things that we're looking at for the economy in 2015 is about a 3% growth rate. And it really matches the average growth rate that we've had over the last 50 years. So when we look at contributions from consumer spending, business capital spending, and housing, they're actually all poised to advance at the historical average or better for 2015.
Well, Margie, the economic recovery actually began in mid-2009, and it's been the most tepid recovery on record. The GDP through the third quarter of last year was only 11% above its 2009 bottom.
Well, I think the one thing about that that's interesting is if we look at all the recoveries we've had since the end of World War II, the economy actually expanded 24% on average in the first 5 years of recovery. So when we look at the fact that, hey, we've only had 11%, that says that there's quite a bit of room to grow, doesn't it?
It does. If we also look, 5 years into those recovery periods, the economy stood 16% above its recession lows, indicating the pace of this recovery is lagging, and we still have room to grow.
So 3 years that we're really looking at, 1982, 1991, 2001, we had years that we believe are more comparable, and we are lagging those. So we think that 2015, we're going to see some positive gains. Again, we believe it's going to be volatile, and we'll talk more about that. But we do think that the economy is going to continue to grow, and we're not anywhere near a recession.
We should talk about stocks. Since World War II, there has been an average gain on stocks of, between 7 and 9% annually. And, this year we're predicting a 5 to 9% gain, including dividends, that's on U.S. stocks in 2015, as measured by the S&P 500.
So 5 to 9% gain, it's not the crazy 20% that we've had a couple years back, or, double digits, but it's still a healthy growth rate. We're still moving forward.
Right, correct. There's some areas in the U.S. that, we're looking at. We're keeping an eye on small caps. They've underperformed last year, and, they could provide some, opportunities for this year. But, overall, we think large cap is, a pretty good spot to be in 2015.
And really, we've been looking at those large cap growth stocks with the higher dividends. But I know, Jen, you and I every day when we're looking at with our team, what's in the current portfolio, and should we be allocating the portfolio and taking things out and adding things in. We're really looking for those opportunities. And, one of the things that I think this year, we've had a lot of volatility already, and it's been mostly due to the crude oil supply. Everyone's noticed at the gas pump that, hey, you can go get gas for $2 a gallon. And, if you have those Kroger points or VG points, or some other grocery store points, you can, I got $1 something the other day, which was crazy to me. But when we look at the impact that, the crude oil's really had on the overall energy sector, long term, I think there's some incredible opportunities there. We're seeing stocks that are at really great prices, super cheap, and have, some pretty substantial dividends. And where we may still see some volatility in those areas, but long term, I think we're going to have some really big gains for clients because of that. So, one of the things, if we look at our expected earnings and not valuation, it's kind of changing, because we were looking at valuations the last few years, but now we're really looking at expected earnings to do the heavy lifting this year.
Margie, a lot of our clients ask us, what is the PE ratio? What do we look for?
Well, one of the things about the PE ratio is, so all of our listeners know, is that's the price to earnings ratio. And it's really the valuation ratio of a company's current share price compared with its per share earnings. So if we have a high PE, it suggests to investors that they're expecting a high earnings growth in the future compared with companies that have a lower PE. So when we look at PEs right now, and we look over a long time period, for example, the next 10 years, PE ratios actually have a really strong historical record of forecasting the market's direction. So we feel pretty good about where the PEs are right now. One of the things that we also should talk about, Jen, is international. I know we've been really conscious about international for several reasons.
Right. Europe is in its third recession right now, and, we've kind of, stayed clear of Europe. It's really volatile, really bumpy. We're just not ready to get back in there yet.
We just don't know when it's going to end. It seems like, when you look at the central bank monetary policy and, the central banks actually decided to have negative deposit rates, which means if you want to go put your money in a savings account, right now in the U.S., we know pretty much you're getting 0%, maybe 1% if you're lucky, but most people are getting 0%. If you're in Europe right now, you're actually being charged to keep your money in a savings account. And the reason they're doing this is to force investors to go put money in other places, in their bonds, in their stock markets. But we're not sure what the overall impact of that's going to be. We went through our quantitative easing or stimulus, and again, that was when we were giving the banks $85 billion a month. And we're done with that now. That ended in October. But we haven't really seen the full effects of our economy yet. It seems to have been working. But when we look at what's going on in Europe and some of these other places, we're not sure how a negative deposit is really, how that policy is really going to work for them. So it's going to be interesting to really see what happens there. And for that reason, when we look around domestically, Jen, would you agree? It's the best place to invest right now.
Right. I agree. Domestically is the place to be right now. Something we should talk about is the cyclical sectors. And, historically, those sectors have performed well during the middle to late stages of the business cycle. And, those companies, in the industrial, technology, and transportation sectors, they're well posed, for better growth. So those are definitely some areas that, we're watching in 2015 and see how they perform.
The other thing, too, consumer discretionary. We're really looking at what is the consumer discretionary we should be investing in, because when we look at the economic cycle and where we're at, we're past the point, I think, where we have to invest in those defensive-only companies. And when we talk about defensive companies, we're talking about we're not talking about guns and ammo. We're talking about, you need food, you need clothing, things that not luxury clothing, but clothing, food, shampoo, things that you're going to buy on an everyday basis, whether or not the economy is good or bad. And so when we look at that, we're really shifting more into the consumer discretionary, which would be those luxury clothes or automobiles. So we're looking in that area as well. And I think that could be a really strong area for 2015.
Right.
So looking at bonds, just briefly here, and we're going to talk more about bonds in a little bit, but when we look at bonds, we're really projecting flat returns. And the reason for that is we believe that rates are going to start to tick up, which means bond prices will go down. But the yields or the interest rate that you're getting on those bonds is so small. A lot of long-term bonds are still in the 2%, maybe 3% rate, that when you look at your interest and the price decrease, you're actually probably just going to be pretty flat. And so we're not really overly excited about bonds right now. Jen, just real quickly, do you want to just tell our listeners the type of bonds that we're more apt to buy in our portfolio right now?
Right now, we have been using, high yield bonds. The high yields have really benefited from the stable corporate credit qualities and low defaults. Balance sheets are remaining strong. The increased yield has created a buffer against price declines associated with rising interest rates. We've also, been using some floating rate bonds as well as some convertible bond funds.
And so our listeners understand, high yields typically have a little bit more risk to them. So because of that, they pay a higher interest rate. But because the economy's been doing so well, the risk of default is a lot lower than it would have been a few years ago. We also are looking at, with those floating rates, the thing about floating rates is they're typically business loans. So a business might get a loan for 18 months to 5 years and have a line of credit, use that line of credit, and then pay that off. And so as rates are going up, new floating rates will be issued at higher rates, which will help not tank that portfolio. And our monetary policy is really going to be in transit in 2015. because the Fed ended the quantitative easing back in last October. We really think that it's an environment where the Feds now are going to start hiking those interest rates, which will lead to increased inflation. We don't think it's going to skyrocket. We don't think we're going to be in a crazy 1980s period of 20%, mortgage rates or anything like that. But we do think that inflation's going to start going up. We think that rates are going to be moving up and bond prices dropping. So it's going to be an interesting year in 2015. So when we come back, we're going to talk more about what opportunities and also some of the challenges that volatility brings, and then some of the things that Jen and I are looking for when we get to those volatile points. So to talk to a financial advisor or ask a question, go to shardfinancial.com and click on Ask Margie a Question link. And you're listening to The Margie Shard Show on Super Talk 1570. Stay tuned.
Margie Shard and her team can help you through life's transitions, whether it's retirement, widowhood, divorce, or remarriage. Call 810-714-5566 for a free consultation. With Shard Financial, you'll get answers and results. Her office is at 1537 North Leroy Street in Fenton. Log on to her website at shardfinancial.com or call 810-714-5566 today. Securities and advisory services offered through LPL Financial, a registered investment advisor member, FINRA, SIPC.
Buying insurance doesn't need to be confusing. Jason Orton will answer all your questions and educate you on the product you're buying. Jason Orton is an independent agent with the David Chapman Agency. They've been serving Mid-Michigan with affordable personal and commercial insurance needs for over 30 years. Don't let insurance confuse you. Call Jason Orton at 517-319-8225 or log on to his website at jasoneorton.com.
Are you getting ready to sell or buy your home? Need some real honest advice? A realtor who will actually get real with you? No false promises, just plain good old-fashioned care, trust, and advice? Then you need to get Christy.
Hi, I'm Christy Candleberry of RE/MAX Grand. I have 20 years experience in this area, and the number one value I bring to my clients is trust and honesty. I get real with them, and I get them moving in the right direction.
Call 810-691-5914. That's 691-5914. Or go to getchristy.com.
Stand out from your competition with a custom-made dynamic website from Shard Marketing and Branding, your small business marketing solution. Whether it's website design, social media management, referral marketing, event management, graphic design, community engagement, and business development services, Shard Marketing and Branding is your small business marketing solution. Call 810-577-5291 or log on to shardmb.com today.
Welcome back to the Margie Shard Show on Super Talk 1570. I am in the studio with my Director of Operations from Shard Financial, Jen Verscher, and we have been talking about the annual forecast, what we think is going to happen in 2015. One of the things that we want to talk about right now is the volatility. So over the last few segments, we've been talking about how we believe that 2015 is going to be a very volatile year. And not that we don't think it's going to be a year where there's growth. We think the economy is going to grow by at least 3%. We also think stocks are going to see a 5 to 9% gain, which would include their dividends. But we think it's going to be a really bumpy ride till we get there. So I want to talk first, Jen, about things that we're looking at. When we see volatility and we have these periods where, normal volatility, we should expect, 3 to 4 pullbacks a year of 5 to 7%, maybe 1 or 2 corrections, which are actually 10% drops or more. What are we looking at? Because clients always say, well, you're telling me it's short term. How do you know, what are you looking at to decide whether it's short term or not?
Right, Margie. There's 5 different things that, we look for or that we're looking at. We're looking at the Treasury yield curve. We're looking at the leading economic indicators, market breadth, purchasing managers index, and market valuation. And it's important to note that none of those 5 forecasters are showing cause for concern right now. So, which indicates that a recession is unlikely for 2015.
Which is one of the big things. I mean, when we're looking at volatility and we're saying, okay, we think right now this is a short-term issue and we need to stay where we're at and not get out of what we're in or buy more for that instance. We're really looking at, are we going into a recession or not? And so I want to talk a little bit about last October, Jen, because last October it got pretty crazy on the market. Mm-hmm. We didn't have a full correction because we didn't hit 10%, although we were really, really close to that. And it went down super quick and came back, right at the point where it almost hit 10%. It turned around and went to a new high almost even quicker, it seemed like.
Right. And, with corrections, like you said, they're usually 10% or more. But things we have to remember is that usually corrections occur from a single significant event, like a geopolitical or natural disaster. Where last fall, stocks fell sharply, there was a number of reasons. We had ISIS, we had the outbreak of Ebola, we had the prospect of Europe heading into another recession. You had the slowdown in China. All of these things drove that sell-off. And, so it was just
short term. We just didn't think that it was something that was going to affect the economy long term.
Right. And, when we were communicating that to our clients, that we didn't feel that we were in a correction. It was just a short-term pullback.
Which it was. And I was actually traveling, the interesting thing, you mentioned Ebola, and I was traveling down to Austin, Texas, and I remember before I went thinking, okay.
I remember.
I said, should I be going? And the funny part was when I got down there, I ended up hanging out with all people who lived in Dallas. So didn't really, I guess the Ebola didn't scare me that much once I got there. But it was all over the news. I remember sitting in the airport and, they were predicting that the whole world was going to crash basically because of Ebola. So we're, when we look at last October, and I actually put a significant amount of my personal money in the market. And I remember calling you from Austin and saying, and I just happened to get that day. I literally happened to get the very low point.
For your 401k.
I did. And I said, Jen, how much do I have left to put in my 401k for the year to max out? And I remember you told me, and I said, go ahead and put it all in. And I had been really holding back some of my money so that I could get a good entry point. And I remember feeling really bad, and my gut felt like gross and sick. And that's normally the time when I buy. I go by the gut feeling. When it feels icky, it's typically a good time. And so I remember having that conversation with you and saying, Jen, okay, go ahead and put it all in. And I don't know if I'm getting the lowest point or not, but I know that this has got to be a great buying point because the market had fallen so quickly and there wasn't anything that was triggering, hey, we're going to go into a recession and this is going to be a long-term thing.
Right. And, before I could even, finish all my conversations and return phone calls with clients, the market had shot back up.
Pretty quickly.
It did.
Amazingly quick to new highs. So the thing about the volatility that we want our listeners to know is it's going to get volatile. You don't want to put your emotional hat on here. You really want to work with your financial advisor, your financial planner, who is going to be on top of this and know what's going on and be able to tell you if they believe that, yes, this is long-term or not just, okay, stay in it short-term, but actually why is whatever's happening, and what are their thoughts, and actually be able to have conversations if you need to. One of the things I think we should talk about, Jen, is how we actually manage money at Shard Financial. We're on daily calls.
Right. We're on daily calls with our LPL research team. We're listening to different economic calls that are out there from, the different companies. And, we're
able to maneuver the portfolio if need be.
Right. And, why interest rates are, at all-time lows, we're definitely being selective. Which sectors, we're looking at using within the bond market, and we're sticking to the shorter and intermediate maturity dates, and trying to buffer the market volatility.
When we talk about our research calls, we're on these calls every day. And one of the things that we do is really look at what's in our portfolios for our clients. And then, is there something that we should be getting rid of? Is there something that we should be buying more of? Is it something that's fundamentally wrong with a company that we're in? Or maybe is management changed on a fund we're in? There's a lot of different things that we're looking at. And as a team, we're basically making those decisions and having conversations. And so I think it's really important that whoever is managing your money has a system and procedures in place and can explain what it is that how they actually invest money, and that it's more than just one person. It's not just me, Margie Shard, it's Jen Verschure, it's Youssef Gariani, it's Amanda McCall helping. It's all of us that are doing, having different parts of this, and then coming together and having conversations and really looking at what's going on with the portfolios to know what, to really make decisions on what we should be doing. And there's times that we make the decisions that we need to get out of something. And then there's times that, we buy more. And so I think that's a really important thing. And I think with the upcoming volatility, there's going to be some points where, like last October, the market's going to be low. There's going to be no long-term reason why it's low. And it's going to be a time that you're probably going to want to put some money in.
Right. And, one of the other things is, we've got LPL, the research, department behind us, and, they're a great resource. And we do rely heavily, on those daily economic calls.
As well as all of our other mutual fund wholesalers and our, our alternative companies that we work with, and the nudie companies. I mean, there's so many different resources available to us, and between Standard & Poor's and Zacks and all the third-party analysts that we're dealing with, we've really been able to actually sit down, have dinner sometimes, have lunch with some of the top money managers in our industry, and really talk about what's going on in all these different sectors, and the bond market versus stock market and things like that. So one of the things that I think everybody needs to look at going into 2015 is really, how's your portfolio set up? How much volatility could you potentially be looking at? And are you able to stomach that volatility? If you're not going to be able to stomach the volatility, then you probably should make some, you might want to make some changes. But you have to realize and be educated as far as what choices you're making if you're going to reposition your portfolio, and what the long-term consequences are going to have. And really, that's why, financial planning is so crucial. Financial planning and investment management are two pieces that have to go hand in hand. And so you need to know, when you're making decisions, how that affects your financial plan in the short term, in the next 10 years, 20 years, 30 years, all the way up to get you through retirement. Before we take a break here, I want to talk really quickly here. I know there's a lot going on in the commodities market. There's a lot going on in currency. And so sometimes we can have some low correlation between the stock and bond market with those entities. But I think that we're going to have to be really careful about what we're doing with both currencies and commodities, as well as possibly using some different strategies for hedging, either with currencies or stop losses, some different things to be able to protect profits as the market's falling, and then able to, reinvest when we do hit those lows. So there's a lot of things that we can be doing to help our overall portfolio and our strategy. So with that, we're going to take a quick break, and when we come back, we're going to be talking about what areas we think you should stay away from. Now, we have some areas that we think you should completely stay away from, and we also have some areas that we think we should just have a really small exposure in. So when we come back, you'll be, again, talking with Jen Verschure and myself. on the Margie Shard Show on Super Talk 1570. Stay tuned.
Margie Shard and her team can help you through life's transitions, whether it's retirement, widowhood, divorce, or remarriage. Call 810-714-5566 for a free consultation. With Shard Financial, you'll get answers and results. Her office is at 1537 North Leroy Street in Fenton. Log on to her website at shardfinancial.com or call 810-714-5566 today. Securities and advisory services offered through LPL Financial, a registered investment advisor member, FINRA, SIPC.
Looking for a mortgage loan and need someone that you can trust with the biggest financial decision that your family will make? Hi, I'm Rebecca Bartley from Icon Mortgage, and I have 17 years of experience in this business. I offer on-the-spot pre-approvals so that you can start the search for your new home. From zero-down rural development loans to conventional and veterans loans, I can make it quick, simple, and all understandable. Put your trust in me, Rebecca Bartley, and call me today to take that first step toward home ownership. You can reach me at 810-516-4227 or go to my website at rebeccabartley.com.
Shard Financial presents Backpack Night, March 5th at 6 p.m. at the Holiday Inn Gateway Center, sponsored by Chassé Ballroom and Latin Dance Studio of Fenton. Backpack Night is a fundraiser for a project of the Food Bank of Eastern Michigan, providing over 15,000 hungry children in Genesee County with a backpack that contains breakfast, lunch, and dinner each weekend and throughout the summer. You can help. Join us for Backpack Night, where you'll enjoy a strolling dinner, a fashion show, a comedy show, live and silent auctions, and more. Call 810-577-5291 or go to backpacknight.com for more information.
Stand out from your competition with a custom-made dynamic website from Shard Marketing and Branding, your small business marketing solution. Whether it's website design, social media management, referral marketing, event management, graphic design, community engagement, and business development services, Shard Marketing and Branding is your small business marketing solution. Call 810-577-5291 or log on to shardmb.com today.
Welcome back to the Margie Shard Show on Super Talk 1570. I am in the studio today with my Director of Operations from Shard Financial, Jen Brasher, and we have been talking all about 2015 and our annual forecast, what we think is going to happen, what clients and listeners need to be aware of. So this last segment, I want to talk to you about the handle with care, the areas that we're being really cautious about. And the first thing, I know we've talked a little bit about bonds, actually maybe too much about bonds, but we're going to talk a little bit more about bonds, so just stick with us here. Jen, explain to our listeners just the basic fundamental of bonds.
Okay, Margie. What we have to remember with bonds is that bonds and interest rates have an inverse relationship. So when rates go up, which we know interest rates are going to go up, bond prices are going to go down. And
because the only way for prices to go up is if rates go down further, and
we're at the bottom. They can't go anywhere. They can't. Okay. So when those bond prices go down, what's really going to be affected is those long-term maturity bonds. And, so we're staying away from long-term bonds.
So 30-year bonds, probably not a good idea.
Not a good idea. If you're holding those assets and rates start to go up, you're going to be holding a declining asset.
And I know that there's some brokerage houses out there that, like to sell bonds because they underwrite them. And they'll say, oh, but you're never going to sell this bond. You're going to get the income. If you have a bond that's 30 years old and you're getting a 2-3% rate, and rates go up to, let's say, 5%, 6%, you're not going to want to stay in that 2 to 3% bond. I mean, you're not going to want to stay in that. And what's going to happen is it's going to come time you're going to want to sell it, and it's going to be worth a lot less than what you paid for it. So, okay, so long-term investment-grade bonds, not a good idea. The shorter duration, those are the things that, we're looking at
putting in our portfolios for our clients.
Okay, so shorter duration, maybe a little bit of intermediate, but definitely not those long-term investment grade bonds. Okay, I want to have a conversation, Jen, about what's going on in Washington, because Washington's really been stalemate the last few years. I mean, we've not seen a lot get done. But now with the Republicans taking over the Senate, it really opens the doors to a lot of changes possibly.
Right. The Democrats took control of the Senate back in 2006. Now the Republicans are in, and, this transfer of power could have a really huge impact on, different things such as Affordable Care Act or tax reform. So, we're really expecting, there could be a lot of movement, in 2015. One of the things with, Affordable Care Act is, there's a impending Supreme Court ruling, on the legality of, the Affordable Care Act subsidiaries.
Oh, my gosh. This is huge. I mean, I think it just recently came out where the IRS is now going to be auditing people's returns based on what they put into information as far as how much they were supposed to make. So if you received a subsidy for your health care and you thought you were going to make so much, and let's say you worked overtime or made more commission or got bonuses or got a wage increase, you may end up owing more money. I mean, how is that even legal? Now, all of a sudden, you thought you were paying one thing. You agreed to pay one thing so you could have health insurance. But now you're in debt and you're going to owe the government because you owe more money and you don't know anything about it? I just don't these rules.
I know. It should be really interesting this year. So we've got that we're looking at. And then I know you touched earlier on energy. But when we look at energy and we look at politically the whole situation, again, I know Saudi Arabia said this is not against any other country, but I just have a hard time believing that there wasn't, there's not some thought as far as how it's affecting Russia and Venezuela and Iran and some other surrounding countries, and our own country too, as far as the amount of investment that's now coming into the U.S. or not coming into the U.S. to build more pipelines and things so that we can become more energy efficient. There's also some big decisions that the president could be making regarding who gets appointed to the Fed, and we know that the Fed controls the whole monetary supply. We're no longer doing the quantitative easing. The $85 billion a month that we were giving the banks is now done, and that ended in October. But the next step for these interest rates to increase has got to happen sometime soon. And again, while we're not looking at major, movements upward, when you have rates that are 2%, let's say, and you get, let's say it moves up by 50 basis points, that's a pretty big percentage of that rate. I mean, it's going to have effects on it's going to have effects on bonds going down. Moving rates up can have an effect on the housing market as far as more people either buying less house, slowing down maybe the growth in the real estate market. Although I know last week we had Christy Candleberry and Rebecca Bartley on. A couple weeks ago, and they were, Christy was adamant that she thought we were going to have another 20-25% gain in Genesee County. Overall, I know Realtor.com is assuming a 3% growth rate, but, movements in rates up can definitely affect the housing market. So whoever's in charge, and then inflation. I mean, inflation's been just ridiculously low the last few years. Right. I mean, we're expecting it to remain, around 2%. We're not expecting it's going to, skyrocket to 8% or something.
But 2% for inflation is just, it's actually not healthy for the economy at this point.
No, it's not. And, one of the other things, you briefly started talking about monetary policy is, in the financial services, back when there was the whole financial crisis in 2008, there were legislation that mandated that banks meet higher capital requirements. We may see a reduction in that, which will really benefit the community banks.
Well, I know there's been a lot of business owners, and we have a lot of clients that are business owners, and it's always interesting talking to our clients who are business owners, because one of the things that they really got affected by was the overall with their credit lines. I know when we had the recession that hit, a lot of companies, not because they weren't paying their lines of credit, but because of how the economy was, they lost their lines of credit, which, I had some clients that went bankrupt because they could no longer afford to, run their business without those lines of credit, because maybe they did work for, the big three and had to wait 90, 120, whatever it was, days until they would get paid. And so pre-funding all those orders, pre-funding the labor, everything with it, they needed those lines of credit, and it was just taken away from them for no reason. And then I have other clients who have had to, go into their own personal lines of credit on credit cards and things like that, just because their lines of credit for their business, and again, for no reason, because of the whole credit market tightened up. So if they do loosen up those lines of credit, I think that's going to be pretty big for the business community.
Right, I agree. And so those are definitely some areas that, we're keeping an eye on.
And we could see a lot more just growth, overall growth in small businesses because of that. When we look at all this heightened activity in Washington and then the shifts in monetary policy, we really see 2015 to be poised to deliver a really strong, actually, economic growth. I think there's going to be a continuing improvement in the labor conditions, a continued environment for fast-growing corporate earnings, and also a more favorable backdrop for expanding equity prices, which, of course, is the stock market.
Right. But 2015's most important delivery is going to be setting the stage for 2016.
I totally agree with that, Jen. So before we wrap up here, the reason we do these annual forecasts is we want you to understand what's going on with the market and the economy, and what we think what we're looking at and what we think is going to happen. One of the things that we are so passionate about at Shard Financial is making sure that our clients have a strong financial plan as well as strong investment management. And a lot of people don't know what a financial plan is, do they, Jen?
No, and we are looking at the larger picture. We're looking at clients' income, we're looking at their expenses, we're looking at their debts, we're looking at their liabilities, and we're using all that, information, to see where they're going to be in 5, 10, 15 years, into returment.
And then to look at the risks that they're doing. Because if you don't, everything starts with what you're spending. I'm sorry, it starts with how much income you're making and what you're doing with that income. And that's the whole start of your whole financial system, really. And so, if you're not doing financial planning, you can have the best investment management ever, but you're not going to necessarily get to your goals. And so it's really important that you have a financial plan, and it's really important that your investment management is coordinated with that. So with that, we've got to wrap up. I want you to join us next week. We're going to have our Valentine's Day special, and we're going to be talking about love and money. We'll have Elsie Hayes from NBC 25 and Ronnie Medawar from Metters, and it's going to be an awesome show. With that, I want to thank you for listening. Rebecca Bartley with Icon Mortgage Lending, Christy Candleberry, the Christy Candleberry team at RE/MAX Grand, and Jason Orton with David Chapman Agency. Thank you for being our sponsors. And you're listening to the Margie Shard Show on Super Talk 1570. Join us next week.